Greg Fleming. He is the CEO of Rockefeller Capital Management. You know, when you look at what your clients are doing, Greg, are they by the way of Stan Druckenmiller, or are they by the way of George Soros? Are they buying again, or are they shying away from the markets? You know,
Sonali, I think cautious is the word I would use for our clients and our private advisors. There's a tug of war that's going on from a macro standpoint in the market, as you know. A month ago, there was greater concern over inflation. We get some good inflation data in the last few weeks, and now people are thinking, well, maybe the Fed pulls back sooner and we can get the soft landing. So because of that, you have exactly what's gone on here. You've got Stan with one perspective, and then George on the other side, because people are reacting on a real-time basis to the way the whole thing seems to be evolving.
To the extent that your clients are cautious, what are they most cautious about? Are they worried most about the Fed, interest rates, inflation, or global chaos?
Well, it's a great question because I would say to some extent all of the above. And the focus moves from one topic to the next based upon data that comes in. So literally a month ago, the biggest focus was on the Fed and the inflation numbers and the fact that the Fed was going to need to continue to move aggressively. Now, a whole bunch of people believe, with the data coming in the last few weeks, that maybe the Fed can actually land this without creating a significant recession, and they might pull back a little sooner. From my vantage point, I think the Fed's going to keep going now, having gotten a late start.
Greg, hi, it's Alix. Really great to see you. Thank you so much for joining all of us. To that point, we've seen, like, Bloomberg Economics here is looking at a 4% Fed funds rate. We've even had guests on that look at 5 or maybe 8%. What do you think? And then what happens to markets?
I think the Fed is going to keep going here. As I said, and Alix, we've been talking about this for a while. They got a late start. They're on it now. So I think that by the end of the year, they keep going 75 basis points probably in September, and they get to 3.5%, 4% by the end of the year. In every major tightening cycle that the Fed started since 1970, the Fed funds rate has gotten higher than the current CPI before they pulled back. So you've got Fed funds around 2.5 today, and you've got inflation, current inflation around 8.5. So those numbers need to get much closer together for the Fed to really pull back in our eyes.
So, Greg, to that point, it feels like that would mean a lot of market volatility. Do you think it's going to mean that this time? I feel like the market has been completely either not listening to the Fed or just straight up ignoring the Fed.
Well, you know, if you went back a month ago, maybe the market was listening to the Fed. They may be, you know, it's rallied significantly in the last month. You know, when you have these transitional times, Alix, where the Fed's trying to get inflation down, obviously they'd like to do that with a soft landing, but that's tricky and historically not happened a lot of the time. But when you're in this transitional time, market volatility is going to stay higher. So it's been a very positive month, but there's more volatility ahead. As data comes in and people react to it, markets will respond accordingly.
Greg, good morning. It's Guy. What happens to wealth in this environment? Wealth has been turbocharged, supercharged since 2008 with the arrival of QE. We're now in QT. How does wealth develop in that kind of environment?
Well, Guy, wealth over time is going to continue to expand as economies expand. So, you know, the wealth management market in the U.S. and around the world will continue to grow through the cycle. The cycle can obviously influence it in the near term. You know, for our clients, where they're putting a significant amount of their wealth, and remember, our clients are primarily high net worth and ultra high net worth investors. They've dedicated an increasing part of their wealth to alternative strategies where there's illiquidity in the near term, but they're investing in best-in-class managers through the cycle, so that what happens in the public markets is a little less relevant for them as long as they're in the right investments with the right managers. So we think alternative investments for high net worth and ultra high net worth investors will continue to be an increasing part of the equation.
Is QT a threat, though, to that wealth? We've had money creation, which is aggregated in the upper echelons of society. If we get money destruction, does the same thing happen in reverse?
Well, QT is definitely, and as you know, Guy, QT is really not kicked in yet. The Fed balance sheet is still close to its peak, and they are going to step it up from here. So QT will take liquidity out of the system. It will create, as a result of that, more market volatility, and it will suppress wealth in the near term. My only point on wealth through the cycle is that as economies grow and wealth is created, the wealth management business does continue to expand. But I agree with your point. QT is going to take liquidity out of the system, just like it put liquidity in the system, as you said, on the way up.
I'm wondering how your clients are thinking about global investing at this time, because we had some really harrowing economic data out of China. We have a lot of concerns in Europe as well, and recessionary concerns to that end. You have a footprint in London. So how are your clients thinking about investing abroad? Is the U.S. the relative safe haven, or are they looking to diversify globally in this kind of new global paradigm we're looking at?
Sonali, there's no question that the U.S. is a safe haven in a lot of ways for a lot of clients, given what's going on in the world. I mean, it is an exceptional time in terms of the exogenous factors that are in the system. I mean, we've had a pandemic, we have a war, and all the pressure on energy. We have the tension in Asia, so that does lead investors, high net worth and ultra high net worth U.S. investors, to be more inclined to invest in the U.S. at the margin. Having said that, there are still places and pockets of investment opportunity outside the U.S., and there always will be. But no question, the last 2 or 3 years has created enough exogenous pressure to make the American market a safe alternative.
Not that the U.S. doesn't have its own challenges. We're walking into a midterm election. What kind of volatility does that create, and what are your clients hoping to see out of the outcomes of these elections?
Well, what our clients are hoping to see is government that works and that gets things done to move the society and the economy forward. I mean, I think there's a lot of support throughout our client base and across the country for what happened with the semiconductor bill and bringing some of the manufacturing back on shore for these precision products and things that are important to the economic strength of the U.S. So I think clients are hoping to see that. The biggest risk from a volatility standpoint, though, Sonali, it remains the Fed. I mean, the Fed. These phrases have been around for a long time. Don't fight the Fed. They're in a significant tightening phase, and they may, to Guy's question, they're going to add quantitative tightening to the equation much more going forward here. So the Fed, even more than midterm elections and fiscal, is really the central player here.
Greg, in all of this, what is your objective? We're going to see turbulent times. It's going to be interesting to navigate. Rockefeller Capital, where's it going?
Well, our objective, Guy, is to continue to work with our clients on longer-term investment plans to make sure, through our private advisors, who we think are the best in the industry, make sure they're working with clients and adjusting those longer-term plans as necessary as the exogenous world changes. We've been, at Rockefeller Capital Management, building out our footprint, as we like to say, across the U.S., taking this iconic name and setting up operations in major wealth centers where we can, through these elite private advisors, begin to serve clients in communities across the U.S. So we're in 38 cities now, and we'll add some more, like Charlotte and Austin and others, to that puzzle, and we'll be working with clients who have needs for high net worth and ultra high net worth capabilities across all of those different offices going forward.
I mean, the reality is you've been adding a lot of teams across Wall Street. You've worked at many places before. You've brought on some of your former colleagues. So how significant can the hiring plan still get? You've already grown from about $18 billion in assets under advisory from when you started to more than 90 now. So what does the growth trajectory look like? Is it that fast in the next couple of years?
Sonali, we had a plan at the beginning when we started in 2018, and we're going to finish executing that. So we're probably halfway through putting this footprint in place across these major wealth centers in the U.S. So we're coming up on $100 billion-ish in client assets, and we'll keep moving forward over the next few years to get into the remaining cities that we think we can serve clients in. and finish putting the footprint in place. And then from there, we'll be servicing clients on a long-term basis through Rockefeller Global Family Office.